So picture this, February 4th, 2026. It was the day the market just broke. I mean, it seemed to be telling two completely different, totally opposite stories at the exact same time. Even the old pros were just staring at their screens, completely baffled. One part of the market was rallying hard, while the other was in an absolute free fall.
Okay, so let's dig into the numbers because this is where it gets really, really weird. Take a look. The Dow Jones, the home of all the old school industrial companies, was actually up. But the NASDAQ, the heart of the tech world, was getting absolutely demolished, down over 1.5%. This was not a normal day, folks. This was a massive, violent split, the kind of thing that tells you a really deep shift is happening under the surface.
And that, of course, brings us to the central mystery we're going to unpack today. How is that even possible? What on earth could be powerful enough to literally rip the market in two? Well, the answer, as we'll see, points to a huge psychological break. The exact moment the market's blind faith in tech slammed head-on into a pretty brutal new reality.
So to really get what happened, you've got to stop thinking of it as just a random crash. It wasn't. This was a massive reshuffling of capital. This wasn't some headless chicken panic. It was a very targeted, fear-driven migration of money, and it had a very specific trigger.
And that trigger? Well, it was a shocking new development from a huge player in artificial intelligence, one that sent a wave of existential dread rippling through the entire tech industry. People are already calling it the Anthropic shock. See, the AI company Anthropic dropped a new tool so powerful it could automate incredibly complex coding and business tasks all by itself. Now, what's so wild here is the reaction. It wasn't celebration. It was pure terror. Terror that this one AI could single-handedly make the entire software-as-a-service business model, obsolete. Just think about that. The subscription model that powers a massive part of our economy was suddenly being questioned.
And look, we're not talking about some small startup in a garage here. We're talking about giants. Salesforce, Adobe. Investors suddenly panicked, realizing that the very thing that protects these companies, their unique proprietary code, might be worthless if an AI can just, replicate what they do on command. The whole software ETF IGV just took a complete nosedive.
But here's where the market's logic just completely short-circuited. And Bank of America, they absolutely nailed it with this quote. If AI is really powerful enough to kill all software, then the demand for the chips that power that AI should be going to the moon, right? But nope, semiconductor stocks fell right alongside software. And that proves the whole thing wasn't rational. It was just a wave of pure, indiscriminate fear washing over the entire tech world.
So as this wave of fear just ripped through the tech sector, that money, it didn't just vanish into thin air. It fled. It was desperately looking for a safe harbor. And you know where it found one? In the most traditional, physical parts of the economy.
So let's follow the money, shall we? It's a pretty clear trail. First, the fear over AI disruption explodes. That sparks a massive sell-off in tech and software. All that capital has to go somewhere, so it starts looking for safety. And boom, it floods into what Wall Street calls real economy stocks. Things you can actually touch, like oil barrels and factory parts. And when you look at the results of this rotation, wow, it's just stunning. On the exact same day the IT sector was absolutely bleeding out, the energy sector was surging. This was like a battle between the digital world and the physical world, and in that moment of pure uncertainty about the future of code, investors chose the tangible present.
And just to make things even crazier, something else was happening in the background. News broke that the U.S. Navy had an incident with an Iranian drone, which immediately cranked up tensions in the Middle East. That made oil, and by extension, energy stocks look even more attractive as a hedge against all this global uncertainty. It just poured gasoline on an already raging fire. But this day wasn't just about one AI tool or some geopolitical drama. No, this was something way bigger. This was the day the market's blind faith in AI, what we can call the AI fantasy, finally shatter. And if you want to understand just how brutal this wake-up call was, you only need to look at one number, -17%. In a vacuum, that's a disaster for any company. But the story of who this happened to and why, that tells you everything you need to know about the end of an era. So that 17% drop, that was AMD's reward for actually beating Wall Street's expectations. Can you believe that? Their only crime was that their forecast for the future wasn't absolutely perfect. It was just good. And in that one moment, the market basically declared that the AI fantasy was over. The phase where any company with an AI story could just soar no matter what, gone. Good just wasn't good enough anymore.
And you know who else failed a huge test that day? Bitcoin. For years, we've all heard the pitch, right? It's digital gold, a safe haven. But on this particular day, it didn't act like gold at all. It acted just like another speculative, high-risk tech stock, and it crashed over 3%. It was a crystal clear signal. Investors were running away from anything that felt speculative, from software code to crypto code.
So here we are. The fantasy is over, the party stopped, and now we're left with this new, much more complicated reality. This leaves investors standing at a crossroads, really, with two very different paths they can take from here. Okay, so path number one. This is the aggressive route. The bet here is that all that fear was a massive overreaction. The argument is simple. AI's progress isn't stopping, and all that progress is going to need more chips and a whole lot more electricity from the power grid. So this strategy says you should buy the physical stuff, the infrastructure that got unfairly beaten down in the panic. You could look at ETFs like SOXX for the chips or Grid for the power grid itself. All right, then there's path number two. This is the defensive strategy. This approach basically says the uncertainty is just way too high right now, so it's time to build a fortress. You move your money into real assets, like energy, maybe through the XLE ETF. Or you could go for dividend aristocrats. Those are the super stable, high-quality companies that have been paying out dividends for years using an ETF like NOBL. It's a classic flight to safety and to things with tangible value. So, where does that leave us? What does all this mean? What are the new rules of the game for investing in the age of AI, now that the fantasy seems to be over? And this, right here, is probably the single most important takeaway. We have officially shifted from the AI fantasy era to the AI reality era. The days of just blindly buying any stock with AI in its pitch are over. Now, investors have to do the really hard work of figuring out who the real AI disruptors are going to be and who is about to be disrupted by AI. So really, it all boils down to two completely different ways of looking at the future. The bull case says this was all just a healthy correction, that it washed out the froth and created an amazing buying opportunity in the real hardware that powers AI. But the bear case, well, it argues that the software business model is now fundamentally damaged, and that combined with all the geopolitical risk, the market could be facing a much, much deeper downturn. And that just leaves one last, really critical question you have to ask yourself. The market seems to have made its choice. It's moved on from the fantasy. So the only question now is, which world is your portfolio built for?